Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Today we're going to be talking about evil hedge fund tricks and traps, smart money traps, institutional traps, bank traps, central bank traps and tricks, whatever you want to call them. We're going to talk about tricks and traps. Now, we've gone over 3-day setups. We've gone over first red day, first green day. We've gone over inside bars. We're going to review some of that, and we're going to go over the most important things that keep occurring, and again hammering home the importance of having best trade setups and understanding what they really are, not just catching a move and getting pips. There is a distinct difference from a scalable, sizable trade setup versus catching a move. And that's really important. Once you understand that, you will cross over into the next level of trading. And that next level will involve size. If we take a look at West Texas, we can look at any instrument, but we'll go through a few different basic concepts. Talk about Monday being day one. The importance of understanding the high and low of the day, the week, and the month. And the importance of understanding the economic calendar. In many cases, the calendar can be used as a tool by the smart money, the hedge funds, etc., to trap volume, to manipulate price activity over 2 or 3 days, or maybe the entire week, setting up for a larger range expansion or a larger move. And that involves, again, scalability, larger setups. When we come back and we start a new week and we take out a level, right off the bat, we're underneath of a previous day's low. Now, I talk about day 1, day 2, day 3. Monday is the first day of the week. But when we break a level, we now have traders from other time frames entering the market. 4-hour, daily, weekly. This is a weekly low. We have weekly traders, potentially breakout traders in the market. Now, it's so important. A lot of traders pay this lip service, and I repeat it over and over again. When you understand the importance of other time frame traders at these external peripheries, you will understand the day count. When we enter into the market and we have shorts in the market and the market goes down, we know there is stops above the high of the day. If they break a daily and a weekly low, we know there is stops above the high of the day. That market reversed on a rectangular reversal, explosive move at the low of the month. The next day we have day 1 longs in the market. Day 1 longs in the market. They set traders up for a New York session high of day sell back into the breakout trader. Not only do they go back and just stop the breakout trader out, but they put 50 plus pips into that trader. And then they pull it back inside and go into consolidation at the end of the session on day 2. We have day 1 longs in the market after a reversal. Which way would we potentially be heading? The next day we're inside. So again, hammering home the importance of either being in the direction of the trend or waiting for this market to be outside of a high or a low, and then it is considered to be out of balance. But we're now in a market that has reversed, and we have day 1 longs in the market. Our bias is now to the upside. Coming back to the simple understanding of the 3-day cycle. If we have a market that breaks out, day 1, day 2, whatever that may be, we now have day 1 longs in the market. If we break out a second day, we now have day 2 longs in the market. Now, we can still have a high day sell for a scalp in the New York session, but we have day 2 longs in the market. Now, we could even have a day the next day that trades inside. And then on day 4, we could have the low of the day hit and an explosive move that takes out the high of day 2. Then we can get a large move back down. We trigger the high of the inside day. We then trigger day 3 longs. We've broken structure on the inside. This now becomes a pump and dump setup for the large reversal trade. One of the things I'd like to really hammer home is that this whole 3-day cycle, 4 days with the inside bar, a lot of this movement is order flow. This move is an explosive, scalable trade setup. You may have a scalp that gives you a high of day setup, or a trend trade that potentially maybe is a scalable move on day 2 in line with the day 1 longs. But when we get day 3, whether that's for longs or shorts, after day 3, that's when we can get a large scalable opportunity, either long or short. If we're at the high of the day, maybe the high of the week, and maybe the high of the month, especially at the beginnings of new months. That's a new timing cycle for the smart money. The hedge funds, the institutions, the banks, they like to lock their books in and lock in profits and then start the game again, trapping traders right off the bat at the beginning of a new month, up high at the high of the month, or down low at the low of the month before exploding, and it defies all logic because the trend is up. And sometimes these markets will fall and give a measured move of 2 to 3 times that range expansion. And again, coming back to my premise and my approach to the market, that everything is inside of a box. So a lot of the price action that goes back and forth that we perceive as trends is actually inside. And when we break one side, and they might stay back and come back the next day, if they've already broken this level and broken out, and it's day 3 or the high of the week or the high of the month, the low of the month, whatever that may be, we may now be targeting the money because we've got traders triggered on other time frames. Remember, as soon as they break a daily high or low, we have other time frame traders that are in the market, larger players, hedge funds, 4-hour, hourly. They're all in the market now. And if that breakout fails, and this could be a Tuesday, we could have Wednesday, traders are tracing this back up, and this could be set up itself for a pump and dump reversal back to get the money. And the same thing applies in the long direction. So when we look at oil, we have a market that is now got longs, day 1 longs in the market. The next day we have day 2 longs in the market. And then on the Thursday we have day 3 longs in the market. Breakout traders, day 3 long in the market. And when we just take a step back, we can see that day 3 longs has also taken out the high of the previous week. Now, I don't care what market it is, but when I get this set up and the next day we had a short opportunity, I look at a few things. I look at the high bull candle on day 3. That's a major potential level of resistance. We had a lower peak formation that formed and gave us a high bull candle on that lower peak formation in the U.S. session heading into the close on Thursday. That high bull can now become a major level of resistance. Now, when we get to Friday, we have not triggered a high or a low of a previous day. However, we've had a breakout of a weekly high that reversed. There's only 3 things that markets do, and I repeat this over and over again. They break out, they pull back, and they trend. That's where we can see maybe day 1, day 2, day 3. Day 3 longs in the market. It breaks a weekly high and pulls back inside. We get a U.S. session high of the day sell after a lower double top locks in our high into our major resistance level our high bull, for a move from the high of the week, the high of the session and the day on Friday, back to the low of the day. Remember, where is the money? We've got day 3 longs in the market. That breakout failed. That breakout failed. If it fails and they come back up into that peak formation, where is the money? It's at the previous day's low. When this day closes on Friday, we have what's called a first red day. Well, what a first red day is when we get a market that makes a peak formation and they trade back up into that peak formation and close down below the open. That closes below the open after making peak formation highs in a market that has pumped up. So we have a day 3. We have 3 days of long traders, breakout traders triggered into the market. And then we have our third day, which is a pump-up day, and then a first red day. This is a perfect recipe for a 5-star scalable setup. On a Monday at the beginning of the week, this price action inside, I know there are traders that went long in the London session on oil. Now, think about this. On a first red day, they pump it up to the high of the day inside of our high bull major resistance level. No news during the day. Why would this market pump up? Why would it pump up to the high of the day and the week on day 1 when there's no reason that this market has any economic data or anything to propel that all of a sudden to just pump up to the high of the day and the week after our first red day? This pump up goes in 3 pushes once it gets to the previous day's high. We have news on the schedule in the U.S. session, but remember, there was nothing that made this pump up. It just did it on its own. That's interesting. But what we get right at the New York Open, at the high of the day, the high of the week, on our first red day with a 1, 2 push, and a third push pin hammer reversal right at the previous day's high inside of our major resistance high bull candle from our false breakout from the high of the previous week. And you'll notice that that is at the high of the previous week where our false breakout failed. We get our bear pin hammer. We have a neckline on our little mini 15-minute head and shoulders pattern for a large 5-star scalable first red day setup, not only all the way back through the low of the day, but we may even have a possible range expansion happening. Now, typically what I do is I use the bodies just because it's conservative, and that gives me a fair estimate of a full range expansion as a potential profit target when I get a first red day setup. So a first red day, when you get it on a day 3 false break, high of the month, high of the day, high of the week, and then we get our false break at the previous day's high, this trade is a 5-star opportunity. Now we can look at gold and we see a very similar behavior. The previous week we had a Monday that, again, no news on the Monday, no news. But we had a big pump up that took out the high of the previous day and the high of the week heading into our London session. That market then proceeded to trade from the previous day's high to the previous day's low. Now understand again how important that is. No news. They pump it up, trigger the previous day's high, and there it is again, our little 3-push head and shoulders pattern for a reversal setup at the previous day's high, and then a little New York 1, 2, 3 low-hanging fruit continuation, because remember, where's the money? We saw the exact same trade today on gold, by the way, and we'll talk about that in a second. It takes out the low of the week, the low of the day, but then it reverses the next day. We've talked about how the markets go into consolidation at the end of a session. It doesn't trigger the previous day's low the next day. There's a first clue. It goes into consolidation without taking out the previous day's low after triggering Friday's low. We already have shorts in the market, day 1 shorts. day one longs were in the market, but they got stopped out. Day one shorts are in the market, but now we've got a market that performs a short squeeze, rectangular reversal, and comes back inside of our Monday's high and low. We talked about how Monday defines the high and low of the week, and then Tuesday will either expand the range or trade back to the other side. Now remember, we have day one shorts in the market. Where are their stops? Where are the other time frame traders' stops if we have day one shorts in the market? Well, in most cases, day one shorts have their stops at the high of day one. Day two pulls back inside and is an inside day. We have the Fed on Wednesday, and then we have non-farm payrolls on the Friday. Now this is typical of the Fed week. We will see a high and a low often form, and in many cases, as we saw in the index, a day one, day two, day three shorts. Third day is when the Fed day is. And wow, amazing how we see an explosive move from the low of the day. We have day one shorts triggered in the market. We potentially may now have the low of the week locked in place. It's an explosive move. We just barely broke the high of day one on the high in the US session. And there's the dump and pump. Let's zoom in on that. We have one push, two pushes, and a 1, 2, 3 heading right into the Fed. And then the explosive reversal engulfment on the 15-minute chart. Now here's another example of how we formed a geometrical structure, a rectangle, for a possible measured move. This gave two full expansions heading into not only, if we zoom back in, we have 3-day setup, and then we have a large breakout, and this becomes our new explosive move for day one, day two, day three. Guess what we have on day three on non-farm payrolls? Wow. Now what's interesting is that on day two, we continued our long trade. We had a breakout trade that continued into the U.S. session. Now we have a breakout trade in the U.S. heading into the U.S. session. So again, we talked about whenever breakout traders are in the market, remember, they haven't been stopped out yet. So there's money there. Now what's really amazing is that when they release the data on non-farm payrolls, that exactly in 1 minute, it went exactly to where the breakout traders came from. Isn't that amazing? But let's go back to our 3-day cycle. After the Fed, we have day one longs in the market. They've broken out of the previous day's high. Obviously, we triggered that at the beginning of day three, but they came back down into the low of the day and it exploded vertically again. And now we know that day one longs are in the market. We also know that the next day, right away, the market continued to go higher. We have day two longs in the market. But on non-farm payrolls, we don't have any breakout traders triggered into the market. And funny enough, that day also closed below the open. Now technically that's a first red day, but we didn't make a peak formation high, we made a peak formation low. But we have day two longs in the market. After payrolls, the market, first 15 minutes of payrolls makes a low, and it goes sideways at the breakout in one push, two pushes, three pushes, and explodes back up to get shorts who were in on the non-farm payrolls news release. We get a new day, a new week, and when that week starts, right away again, we get that follow-through, possibly on the non-farm payrolls, that follow-through on the fundamental data release. They break out of the high of the week, the high of the month, and that gives us our day three longs are in the market. Day three longs. Now remember, I just said earlier, whenever I get a day three long or short in the market, I may have an opportunity because now I know that longs are buying on other time frames on the breakouts. And then when we get our third day, whether it's shorts or longs, I may have an opportunity. They come back inside after the breakout. However, this market has now pumped up from payrolls. We've pumped up one push, two push, and a third push. And on day three, the market will often blow off in the direction of the trend. I'll say that again. On day 3, the market may often blow off in the direction of the trend. When this happens, and I come to trade the US session, this market already has day 3 longs in the market. We know that on day 3 especially, when we get day 3 longs or day 3 shorts, other time frame traders potentially have their stops at the low or the high of the day. And remember what I talked about. Where is the money? On day 3, you have a high probability of a trading opportunity. Now, sometimes you're going to get a first red day. Sometimes you're going to get a first green day. But after payrolls, we're on day 3. We have a first red day, except that the market is still breaking new highs, but that's our day 3 long. We have traders long on day 3 at the breakout that has now come back inside. These traders are now caught. If they're wrong, where would the money be? It's down low. And this is what we call our low-hanging fruit trade opportunity. I just find my high bull, I mark it off, we've got a neckline. The market then proceeds to engulf the high bull and collapse back down through the low of the day, the low of the week. On Monday, our day 1, which happens to be day 3 longs caught in the market. This is an explosive, scalable, low-hanging fruit trade opportunity. Now, we can look at currencies and see the same thing. We have the Fed, and this is the British pound. We'll compare the pound and the euro. We have day 1 longs after the Fed. Day 2 longs the next day. And you'll notice again on non-farm payrolls Friday, if we have our 3-day cycle, day 1, day 2, day 3, it's an inside bar. It doesn't break any of the boundaries at the high or low of the day. But on Monday, we get our day 3 longs at the high of the week, the high of the day, the high of the month. And we get our lower low and then a pump up into the breakout level, the previous day's high, for the US session short trade inside of our false break. Now, they haven't gotten there yet, but there's a high probability they might be heading somewhere where the money is. And it might not happen until day 2, but I'm pretty sure they're going to go and get the money. Now, here's a comparison. Slightly different chart on the euro, but a great example of how we can get a variation in the same type of behavior. Day 1 longs after the Fed. Day 2 longs the next day. And day 3 longs slightly into the market on non-farm payrolls Friday, but the market continued to come higher. On day 4, day 1, day 2, day 3, a slight variation, higher highs, but they pump it back up into the high of the week, trigger breakouts, but then come back up to that high in our US session. Lower low, there's our pump and dump. They pump it back up to the high of the day with a lower low. That's a break in structure on the inside. They pump it up, and there's our engulfment candle in our first hour of the US session for the short trade back down to the low of the London session. Now, this market's obviously a little bit stronger than the pound. So there's an example of where, even though we had a great high day opportunity, maybe the pound was a better setup. And even better, possibly it was gold. It was already broken down. It gave us the continuation low-hanging fruit trade. Very similar, but just some subtle variations. Now here's an interesting pair, the US Canadian dollar. We have our Fed. Now we had a breakout on the previous Tuesday. The market broke out on Monday, continued higher into the close. Now there's a great example too. A market that pumps up into the close, into the end of the session on a Monday, a no news Monday. That's interesting. They pump it up, no news, it gets pumped up after a breakout, and it comes back down to the low of the day. A pump and dump, because what would really make that happen? There's a great opportunity maybe for Asian session traders. No news and the market pumps up, but then it reverses on the inside right away in the Asian session and collapses down in the Europe window. So we've got all this US session that's trapped they get stopped out or trigger shorts, and then the market reverses on the inside and goes vertical in our US session. But remember, most breakouts fail, and on the Fed the market reverses down, starting our count from up top at the high of the week. Day 1 is the high of the week. Day 2 is our Fed day. They bring it down low. Day 3 goes sideways, puts in a low of the week possibly, and then Friday trades back up and triggers longs into the market, but then fails into Monday morning, our day 1. Day 1, day 2, day 3 sideways, day 4 false break, and then Monday, the beginning of our new week, they trade down into the low of the week and bring it back inside and trade down 1 push, 2 push, 3 pushes into our US session at the low of the week and the previous week's low, previous low of day, for an explosive short squeeze, which interestingly enough makes a funny shaped W formation, a double bottom reversal. This is where, again, shorts can get trapped down low, similar to how longs can get trapped up high. They have subtle variations, but these 3-day setups are the little tricks and traps that the smart money, the hedge funds, the institutions, the central banks, whoever is running the market that you're trading, potentially uses to trap traders in the wrong direction. Day 1, day 2, day 3, sideways, a break in structure. And remember, when you see the break in structure, start thinking dump and pump. If it's the other way, think pump and dump, like non-farm payrolls. Take it down, stop out the higher level longs, and then pump it back up and get the shorts. Trigger false breakouts at the high of the week, the high of the day, the high of the month, and then roll it over and start the process all over again. 3-day setups, highs and lows of the week. Use the economic calendar to trap traders, and sometimes that trap is the session itself that the news occurs in. We can get U.S. session news for explosive trades in the Asian session. Here's a great example. The same day that we had the Fed on the pound yen, we had a 3-day setup. We had the peak formation high on Monday. Day 1 shorts are in the market. Day 2 shorts on day 2. And then they pump it up off the low of the week, the low of the day on day 3. We had non-farm ADP. We also had prelim GDP, and then the market reversed after the news at the high of the day, straight back down, back inside of the previous day's high. And then it went sideways into consolidation. That's a false break. Whenever they go sideways after a false break, I'm looking for an opportunity in the Asian session, because remember, if they've broke out on one side of a boundary where other time frame traders are triggered into the market, where is the money? High of the day that failed, low of the week. Breakout traders are in the market, counter trend to the underlying trend. The U.S. session brings traders up on data. There's a high a day selling opportunity that just doesn't quite follow through. A great sell-off, then it goes into consolidation. But the next day in our Asian session, we have a high bull candle that could act as major resistance. We have a consolidation. The market goes sideways into consolidation underneath of our high bull after a failed breakout. The target is the low of the week. But I still need to have the opportunity present in that session, because maybe I'm not going to get it until Europe or London, except in this case we had 1 push, 2 pushes, and a 3rd push with a 1, 2, 3 right into our our Asian session, and then an engulfment candle for the short explosive trade that continued lower and triggered day 3 longs in the market. Remember, we only had day 3 shorts in the market. We had our day 1 shorts, our day 2 shorts. But on our 3rd day, we didn't get this little pin, that doesn't trigger breakout traders. That might hit stops. But that's a breakout. That's a day 3 breakout. Day 3 breakout that came from inside in the Asian session after a failed breakout of the high of the day in our US session with lots of data on the table and the Fed. And then we had our high bull major resistance candle and a consolidation that gave a perfect low-hanging fruit, explosive, scalable trade setup in the Asian session. Point I'm trying to make is that these tricks and traps that the hedge money, I call it hedge money, they use them over and over again. So for the traders who are struggling with the day count, remember, day 1 longs are when breakout traders are in the market. Now that can fail, especially on a Monday or a Tuesday, because that's when they establish the initial balance, the high and low of the week. So my advice would be to go back through your charts. Understand when you have a day 3 opportunity, because day 3 is scalable. Those are scalable trade setups. Hopefully that helps today, traders. Study these tricks and traps, the 3-day setups. Look for day 3 opportunities, especially when you're at the high or low of the week. First red day, first green day, inside days, low-hanging fruit for explosive, scalable trade opportunities, trading along with the smart money. Have a great day. Start the week off strong, and may the markets go with you.